Okay, hey everybody, welcome back to this week's midweek breakdown of the market. Let's drop right into it. We're gonna start out with AUD JPY. I like to go over. I don't know if I did go over, but I like to go over July. What happened in July? In this case, which I really liked this trade right here. I think I already went over this, but just in case, I'm gonna go over it again. This trade was really interesting because we could have really profited on this one, but what I was scared of, it was just that the last leg wasn't corrective enough. That's the only thing that was of concern that kept me away in the middle section, right? The middle section was super creative, was corrective. So it really gave me the feeling that it was gonna correct, drop, correct again, right? And then drop. But that wasn't the case. This one it really pushed with the momentum, which could have profited me a good bunch actually right now. Right now, what it's doing, it's really in the no man's zone. I think that it will continue to push up, following by this mini correction. But to me, it's not really enough for me to enter to say that it will. Um, the proof of direction, the structure, it's just all not there for me. I would rather have this one continue to develop before even having thoughts of getting in the trade. CAD JPY, that's the one that I was gonna go over as well. CAD JPY was really good. I did like it. All right. This structure is the same deal like EJ. I don't know if I went over it. I don't think I went over it actually. September 20, September 18th, September 17th. I don't think I made a video on that yet. But regardless, I really did liked CAD JPY. It was continuation, correction, continuation, correction, continuation, correction, and the obvious thought of where this pair would be going was to the downside, continuation on the bear. But the only thing that gives me concern that didn't help me get in was that the last leg, right? The last leg really threw me off. I really didn't like that. But even then, right, it's not even just the last leg. The last leg is already unattractive enough because it's corrective, and then the middle section is the middle section is corrective, and the last leg is impulsive. So I really didn't like that. The detail of the structure, I didn't like as well. It really didn't fit my standards. Usually, if this trade is to be a little more attractive, it would not have this um, this candle area here that is giving discrepancy to hit this area. If this one was lower and it's more corrective going up, then I would definitely take the chance to get in, as it is 30, so 1-to-4 ratio, so that's really good odds. And then precise entry, everything's on the money. But it was corrective, structure was bad, so it was a no. It is actually going up right now, but number one, this is not enough pit. There's not enough pip for me to be attracted to enter unless it develops something that goes down, correct, goes down again, correct. Then I would say, oh, then I would be interested in this pair because it's attractive enough, structure is good. area of direction is really clear. So if I were to do 190, I'll give it 35 pip SL. So 1 to 5 ratio, really good odds. But as far as it goes, it wasn't developed as such. It was more, what the hell is, it was more that we went over. That's what happened, which really didn't fit the criteria to get in. So next one is Euro USD that I like to go over. Euro USD, sorry, 1 second. Sorry. So Euro USD, let's go over that. This one's a little more complicated than all these other ones. Euro USD, I was interested to get in had it been able to hit somewhere around this area here. That was, dude, holy cow. So, um, it was okay, but but it didn't hit the area value that I was looking for, right? Or I mean, even in that case, I probably wouldn't have entered because yeah, it's just the wedge is too big and everything. I probably wouldn't want to enter, but it would have been an alright trade if it hit the area value, but it didn't. 1 to 6 is pretty good. But right now, what's going on is a double top structure, and this double top structure is really it's not bad. I mean, I would have had the structure been better. It's not bad. I mean, it's just that the bottom here doesn't fit in my criteria. But so far, I mean, it's doing pretty good on its own. So, I mean, I would be more attracted to monitor this area than to just throw it away, right? Because we got ascending within ascending. We got ascending within ascending. And the ratio is super good. Right, 1 to 135 pips. Almost 1 to 6 ratio. So it's not a bad trade, but I'd rather stay out of it. I'd rather stay out of it because it's not about losing the 1% that gives me concern. It's more of the mental stability. If you lose a trade, and this is the same thing over and over, the consistency is key to this, right? And it's the same um, it's the same deal on every single video. If I lose 1%, that's not a problem, right? It's more of losing the mental stability of it that throws you off the game because now you want to win the 1% back, and then when you want to win the 1% back, you're going to be seeing things that you shouldn't be seeing. You're going to be seeing things that isn't there, right? And when you're seeing things that isn't there, you're going to get into more trades, more bad trades, and then the consistency of losing is going to continue. So I'd rather just stay out of it, monitor instead, put it on yellow and monitor it, and get more data out of this, get more information, how it moves, how this pair moves and everything, rather than getting into it impulsively, get in with greed. I mean, you only learn this so many times. You only f this up so many times to learn to not get in. So I'd rather just stay out of it, monitor it instead. It's a pretty interesting pair, but if we look at it on a higher time scale, that's where it really, I mean, this structure is over 30%, so it really gives me no concern. So the attractive one really still comes down to right here, but I just didn't like that structure here. I know what's going on right now, that my standards are pretty strict, but I'd rather have a strict standard than a loose standard and lose 1% and then 2%, and then when you lose 2%, you want to win back to 2% and then lose another 2% because you want to win back that 2%. Then you realize, how the fuck did I lose 4%? So it's just this rabbit hole that goes downwards. Instead of having that to happen, you learn that the mental stability in being in the market is more important than winning the capital. Yes, the capital is great, but you lose the game when you lose your mind. So I will always preach this again and again, right? So for instance, GBP JPY, well, moving on to GBP JPY, let's look at the detail in this structure. The details of this structure, it wasn't good right off the bat. If we do a replay and go back to here, I already didn't like it then, because the structure over here is so corrective, where it's telling me that even if it's corrective here, it'd be better, but that's not what happened. When this happens here, it throws my game off to say it's a red flag right there to tell me not to enter, right? But if you were to play, right, continue, play, stop, this right here is already a no-no. It's not corrective enough. It's, when in comparison to this middle section, this is more of an impulse than a correction. If this pair had just came down like this, right, and you got right here, then I would say, okay, that's not bad, right? That's not bad. But when you're looking at this whole section here, it's a structure of its own. And when it comes up this aggressively, in comparison of the two, this is more considered as an impulse than a correction. And when that happens, it's a no-no, right? You rather just collect data from it, stay on the sideline, and see what happens, right? And when you do that, I put a green, but I don't know why I put green. I thought it was going to be a better structure that was going to create, but look at it right now, right? It's bad. This is more for data than for entry, right? So let's move on to GBP Swiss. There's not really anything to talk about. If it continues to slide to the upwards and do the continuation thing, then I would be more likely to enter because it's giving me proof of direction. But right now, it's no structure, no validations, so no entry. I'm not even going to bother with it. Actually, I don't know why I put this here. GBP JPY. GBP JPY, I was looking to enter this pair. Had it go up, right? Because this is not a bad pair. This is not the best, but it's not bad either, right? So the middle section we see right here, right off the bat, is really attractive to me because it's one candle slide right down. That's impulse to me. Middle section, impulse, that's a good sign of entry. Now we just want the last leg. The last leg is a corrective. Well, if it were to form a correction, I will be more likely to enter, right? If that's 1 to 5 ratio, that's really good odds. 1 to 3. The lowest we take is 1 to 3. 1 to 2, I don't really like. I mean, it doesn't really work out for me anyway. So 1 to 3 to like 1 to 10. But all the things need to be aligned. 1 to 3 is not, if you were to take a 1 to 3, right? In this case, 100 pips, 90 pips. The last leg is not, we don't really have to be as strict as a 1 to 4. Because if it's a 1 to 4, then you need to be a little strict. How do I know that? Experience and data. So in this case, it didn't hit area of value that we were looking to enter. it really just took off without us, which is fine. I mean, it did what it did. We didn't get to enter. Those were the standards. That is the strategy, and that's it, right? So it's fine that we didn't enter. It took off without us. At least we were right on proof of direction, right? Point 1, point 2, point 3. This is technically considered as one, and this one right here as well. But if it happened 5 times in a row, and on the 6th time, the likeliness that it's going to happen, that's going to be a continuation, is higher than saying, well, I'm going to guess down then. Because it happened 5 times, I'm going to guess down. And that's where the market catches people, because they're like, oh, well, it kept going up like 5-6 times. It must be going down. No, it's showing that the market is trending in a certain direction. And when it's trending, you can't go against the market. You can't go against the bank, right? That's really essentially what's going on. You can't fight the bank. You will never fight the bank. You will never win. Well, that's pretty obvious, but nobody seems to follow that rule. The last one that I'm going to get into is GBP USD. It's developing. I'm putting it as green because I'm looking to get into this one. I really do like this one, right? It's got consistency, right? Correction, continuation, correction, continuation, correction, and then continuation. And then if we see a higher time scale, you can kind of see where it's trending, right? And it broke through the double top. I only inverse this. So it broke through the double top. It's created a correction for a continuation. And right now, if it were to do the same, who am I to say, oh, well, it's going to reverse? No, you don't. You can't fight against trend. You cannot fight when the market is trending. It means it's doing its thing, right? You don't have enough money for that. Even if you have $20 million, you can't fight trending. You can't fight bank. All right, I can't emphasize that enough. So if it develops, creates a flag, I'm going in. But you have to understand, I'm going 195 pips. 195 pips, 35 pip SL, 1-to-5 ratio. 195 pips, I need to follow everything to the T for it to favor my way, right? That's the thing about trading. When you trade, you have to get all the odds, instead of against you, with you. That's how you be successful. And then when you mix that with consistency, that's how you stay in this game for the long run, right? So if this trade is to develop, that is what I'm going to be looking for. That is the structure I'm going to be looking for, and those are the standard, right? So that's pretty much it for me. I'm going to monitor these pairs, and we went over all these other pairs, so we should be good. I would like to journal all of that just to get the mind right. So just to exercise the mind. But it's the same deal on every pair. I don't even really like this. It's a double top, but I still don't like it. GBP, JPY, I can easily see that it's going up. It's not. I mean, I really need to monitor how many pips these takes, but it's usually going up. It's not having the right structure, so it's not my standard structure, which I can easily see that it's going up. But this is pretty much it. Those are the pairs that I'm monitoring. I'm not monitoring this. I know this one's going to continue to go up, but the only one that I'll be looking at is GBP USD. So if I am to see a trade, I will put in the Telegram. So that's pretty much it for me. If you find this video really informational, give it a like and comment on things that I look for. If you want to make comment things that you want me to make a video on or content on, just let me know. Maybe if I take interest to it, I'll make it. But as far as that goes, peace out.